Andrew Malcolm here, Mortgage HQ. Today we're talking about how the COVID pandemic has changed my investment strategy. Now, I just want to couple this with the fact that COVID, the pandemic, what that's probably done is trigger property cycles and economic cycles around the world to start moving and potentially impacted those property cycles. So check out the other videos about property cycles, reflecting on what's going on in Auckland and New Zealand, where I am based. How COVID has changed my investment strategy is I'm starting to think more about having a higher base of funds in reserve. So what does that mean? Where I would have been happy to buy an investment property and use all my money in the recent past as rates have been going down and the market has been really buoyant, I'm starting to think, okay, before I buy another property or when I do own more properties, then I want to have more mortgage funds available in my account if my income gets hit or I miss out on rent. So if you've got $1 million mortgage and it costs you 50 grand a year to pay that mortgage and the rent only covers say 35,000, then you need to start thinking, okay, how much should I have in reserve? 3 months, 6 months, 12 months in case anything happens. So I'm starting to think just for myself, have a little bit more funds in reserve before I take that next step. To couple that, what I'm starting to do is instead of projecting out my numbers using say maybe 2.5-3.5% range for the coverage and the yields that I'm getting and what I'm going to have to pay for that debt, I'm starting to think about whether, doesn't matter whether it's going to happen or not, it's a safety net. I'm starting to think about if my mortgage is at 5%, and that helps me run the numbers and see that a lot of the properties I would be looking at or might potentially buy would be negatively geared, which means the rental income doesn't cover the mortgage, which is totally fine if you can afford it. But if you can't, or you get in a situation where you didn't predict that you were going to be negatively geared and then you became that, then you just need to have that in the back of your mind. If you buy an investment property for the right reason, location is right, the future potential is right, but for 2 years it's going to be negatively geared, totally fine as long as you've thought about it and you can afford it. The things that haven't changed as a result of what's going on in the market at the moment is my location focus. I'm still focused on the market in Auckland, where I believe it's still long term the best place to buy. I'm not an expert in other areas, so just because I might be chasing yields or worried about Auckland market property cycle, I'm tending not to start looking in other areas, and I just wait for that right time to jump. And the way you can think about it is, okay, maybe you can buy another property now, maybe for example say in Rotorua, and it might be 2 years before you can buy in Auckland in that range that you want. You've got to weigh up that decision of whether it's worth waiting or worth going on that Rotorua property, and only really you can make that decision. To mitigate and manage those risks of rates going up and potentially be negatively geared, you might want to consider partnership or joint ventures. It's definitely more on my radar now because of what's going on with COVID and potentially people not being able to afford their rents, and you might be able to not generate the income on properties as much as you'd hoped. What you can do is share the reward and share the risk with a partner if you buy another property. So talk to your advisor about the implications of investing with, say, a group of people versus just buying on your own. Now, longer settlement when you're looking at an investment property does help you get more time to finance the purchase of a property and more time to think about it. And you can pay, if you're finding it hard to compete in the current climate of winning a property, what COVID has done is said, look, make sure you've got to have your clause in there about delaying settlement if lockdowns hit, but also give yourself 6 to 12 months on that long settlement period. You can pay a bit more and give yourself time to arrange everything. COVID is just a blip. It's really easy to get trapped in this mindset that the pandemic cycles are just going to keep going and going and going. But if you look back over history, we've had pandemics in the past. The markets will recover. There will be a lot more confidence in the market, whether it's in 6 months or 5 years. There's going to be really keen property investors and a real big boom in the market sometime, and it's just about being ready before that happens. So don't lose focus. Obviously, if your income's been impacted, you might have to redirect your focus away from property investing, but this is a time to learn if you're not taking action. hit subscribe, and don't forget to ask questions about changing your investment philosophies based on the pandemic below, and we'll get back to you.